So this is a multifamily deal structure reference guide that has included in it the equity splits, the fees, the typical returns a multifamily real estate investment could receive, right? So for the equity splits, we have our 70% that would go to the investor or our 30% that would go to the sponsor. That's a typical split. You could also see 75% that would go to the investors and 25% that would go to the sponsors. Then if you scroll down, we have the fees, right? We have the fees. We have our acquisition fee. We have our asset management fee. And we also have the disposition fee. And those range all the way between 1% and 5% for the acquisition fee, asset management fee between 1% and 2%, and the disposition fee between 1% and 5%.
The returns that you're looking for are going to be 15% internal rate of return, 10% cash on cash return, or 100% total return. And then,
right. And Brian, can you walk through what the internal rate of return is again?
Yeah, why that's your average compounded rate of return over the life of the project, right? So year one could be slower, maybe 5 or 6%, but then by the back half and certainly when the property sells, you're getting a higher rate of return. But when looking at return metrics, you need a way to say on average, what are you getting each year as a compounded annual rate? And that's what this calculation does. And I know we reviewed exactly how that calculation works in the calculations section. So if you got to go back and kind of refresh your memory on how that works, that's in the first section.
And Brian, to add to that too, so the IRR is the way you can compare a real estate investment to a stock investment, to a bond investment, to other types of investments, right?
Yeah. It would standardize your rates of returns for these different instruments that you want to look at, and then you can see which one's really providing the higher rate of return. Cash on cash return, you'd want to look for a 10% rate, and then total return, right, which is really your total return on investment for the money you're putting in. You want to essentially 100% or doubling your money, and then just some other considerations, right? So for sponsors contributing to the deal, right? Sponsors putting their own money in as a limited partner. People like to see at least sponsors putting at least the minimum amount in, and they really like to see if they put 2 times the minimum amount or more in. Just kind of a vote of confidence that the sponsors have really a lot of faith in this property. The typical holding period is going to be 5 to 6 years. The investor LLC typically does have the title to the property, and then your manager LLC is going to be a separate entity, right? That separates managers from investors and gives investors even a further line of defense, in the event that anything does happen with the property, right? The managers who are controlling the property are a separate entity and can be gone after separately from the investors. And then your preferred return is in the 6% to 8% range.